Ready?
Ready.
Hey everybody, this is Colin Meeks with Ryan Stark with another edition of our podcast, The Financial Advocate. Thanks a lot for joining us. Just as a reminder, you can always get a lot of the resources that we talk about on these podcasts at our website, and we post them to the show notes, marylandfinancialadvocates.com. And today what we're going to do is just sort of like a weekly wrap-up / case study, things that we've heard that might be helpful to folks that are listeners. Under the advice of Ryan Stark, who just recently did a group presentation down the road here in Bethesda, Maryland for, what group was that, Ryan?
It's like a neighborhood group where they get together and actually do a bunch of different presentations just to benefit the community.
Okay.
I just happen to be a financial advisor who stepped in this case, but they've had other people present as well.
Right. So during that, you did some questions and answers at the end, and you got a good amount of questions on life insurance. And this is, none of us are ever going to die, right? So this is not for anybody listening to this, but maybe maybe somebody you know is going to die.
Right.
So we just wanted to run through some basics with life insurance, and it's really important to remember when you are thinking about life insurance. You think of it in your overall financial plan, and you've heard us say this 1,000 times if you've listened to the podcast. You don't want to lead with a financial product. We want to put together a financial plan and figure out what exactly it is that you need and then fit the financial product into that plan. So starting there, life insurance. Brian, what kind of questions did you get when you were doing your presentation?
We had a lot of retirees there and people who've been retired for some time who held on to their policies. And I think we've actually met with a few clients recently who've been in the same situation. And they were asking me, do I still need it? Do you suggest I hang on to it? And I think just like you said, the reason we plan is because it depends on how much death benefit are you getting for the premium. Is it worth it? And is it still fulfilling the purpose that you bought it for in the first place?
Right. And that's, not getting into there's literally hundreds of companies maybe not hundreds, but dozens of companies that offer life insurance. And of those dozen companies, there are hundreds of different types of policies. And, you've got term insurance and whole life and universal and variable life and second to die. And it just goes right on and on and on, and people get very confused with the lingo. But the first step in the process that we use is that you do indeed need to sit down and figure out, if you are a retiree, let's take it from there, and you've got this policy that you've had for years, how much are you paying and what is it worth and is it really necessary to have it?
Right.
Just to give you an example, if you have, a lot of people will just have a burial policy, maybe $10,000 or $25,000, and it may even be paid up. It might be to where the dividends are paying the premium, or it was just set up to pay up for from the get-go, and you're no longer paying premiums. And in most cases, that's not a bad thing. We'll recommend, unless there's a really good reason for getting rid of a policy, something that's paid for and is an asset to you, usually is worth hanging on to. Where we run into issues with people, especially with retirees, when we look at their insurances, is retirement is all about cash flow. And any decrease in expenses, we always tell clients, if you decrease in expense, it's just like increasing your income. So if we're looking at insurance that you're carrying and it's something you bought 20 years ago when you had a mortgage and kids at home and college expenses and all those things that you're trying to protect against if you pass away, if they're no longer there, let's take a look and maybe decide, is this really a viable option?
Yeah, agree completely, and realize that you're paying for something and you don't want to, specifically in one case we were dealing with, she was wondering if she should continue to help her children. They're already married, they have their own kids, they're developing their own assets, and while every child, myself included for my parents, would appreciate life insurance, I would never want them to hurt themselves financially and hurt their cash flow just to pad me a little bit in the future. That's not what it's there for.
And one of the big advantages to any sort of death benefit for life insurance is it comes quick. So when somebody passes away, within a week or two, money's in the mail to them, usually. It can be tax-free, it can be income tax-free, and it can also be estate tax-free. Most of the time it is, and under certain circumstances it's not. But for the most part, it's a very good way to pass wealth from one generation to the next, provided that it's done the right way. But having said that, in the case that we were talking about with this lady she's getting ready to retire, she also, the policy she had was a term policy. and every single year she was getting an increase in premium because she hit the age of 65 and the initial term had run out. So this is one of those things where, every year she's going to be just a little bit more aggravated in keeping this thing. And it was, $200, maybe $150 a month, and then this year it was $165 a month, and next year it's going to go up to $180. So we were sort of looking to help her make a decision on that based on all the other stuff that we were trying to do.
And I can remember before, when I was just getting into the business, it was probably 3 years ago or so, I had a family member who called me, and there was a term policy. I think it was a 20-year, and it was my uncle's, on my wife's side, his mom, and her policy was coming up, and she was just turning about 85, and in order to renew, it was like a couple $1,000s in premium. And he was wondering why that was. He felt like it was astronomical, and it absolutely is. But what they're saying is that it's done the 20-year term, and now you're looking at insuring an 85-year-old person, which is obviously putting more liability in the insurance company's hands, so they're going to bump the premium up, especially in a term policy.
And I would say that there's almost never a bad time to review your coverage. I mean, even if you have a 20-year term policy and you're only in the 7th year or the 14th year, so many things have changed in the industry. The way they underwrite anymore is different. The way the policies are priced, the way that the premiums are set, the types of companies that are doing business now. I mean, there's this competition to just continue to get more insurance business. And if you have an existing policy, just because you have it, it may be fine that you keep it, but at least if you do a review with your financial advisor, just ask them to take a look at it, because all you have to do is hop online now, and it's a commodity, it's a price. As long as you're dealing with a decent company, it really would not matter if you could save a couple dollars if you're insurable to go buy to look at and consider another policy.
Yeah. A lot of good reasons to get an insurance policy, and why there's planning is because there are so many situations. You can have the term policy if you're young and you don't have much cash flow. I just had a daughter, so getting a term policy is on the top of my list, and in order to take me out a couple of years, maybe until I'm making more money, and then I can decide if I want to extend it with another term policy, or if I want to have whole life or go from there. Depends on my health and all that stuff. And another big way that we use it is the second to die policy you mentioned, which is usually to fund special needs trusts, which is something we've probably mentioned in previous podcasts in terms of planning for a special needs family.
Right, and the big thing with insurance is your need. Is it a permanent need or is it a temporary need? For instance, say you buy a house and you just want something to cover the mortgage. Well, that's a temporary need. Whether you buy a 10-year mortgage or 15 or 30 year, you can buy a life insurance policy that sort of coincides with that. When we're talking about funding a trust, especially a special needs trust, that's a permanent need. Because parents are going to die, and unfortunately, they need to plan for that. And the permanent nature of that is that when they pass away, they want to make sure that insurance is there and ready to pay a death benefit to that trust, so that that person, the beneficiary of that trust, is taken care of. The last thing in the world you want to do is cheap out, and buy a 20-year term policy to fund a permanent need. And something happens in the 21st year, and you had that policy for 20 years, and then you don't have it anymore, and then what you planned for happens later, and you've basically just not had the right coverage in place. So there's different costs, there's different benefits, there's different companies, there's all different ways to do it. And for that reason, on our website, what do we have, Ryan, for people to look at?
We have the insurance shoppers checklist. Yeah. Insurance shoppers checklist, which kind of helps you get organized and lets you see as you're going through the insurance process, or if you're thinking about getting insurance, kind of how to get organized and how to go about it.
Right, and just like a tax return or a financial plan, we look at insurance every single year for people, no matter if they just bought it last year or they bought it 5 or 10 years ago. But we have this shopper's checklist, and basically we've put it together so that you can just go on there and run down 9 quick questions and figure out, hey, is it worth having somebody take a look at this, or am I good with things the way they are? And again, with the advent of the internet and pricing and the commoditization of financial products, it's not real hard to do anymore. But 9 questions, so you can hop on our website at marylandfinancialadvocates.com and just go into the resources section and download this. And I think it's 9 questions that take you 30 seconds to do it.
Yeah, going back to my presentation, when I had a couple questions of do I still need it, unfortunately I couldn't give them a good answer there. You know, I can't say yes or no. I had a lot more questions for them, and some people pulled me aside and started to talk to me a little bit personally, but really I don't feel like I'm doing my due diligence unless I spend a lot of time getting to know the person so I can feel out their life and their goals and kind of understand what the purpose is, and then I can let them know whether they want it or not. So it was good for me to be able to explain and educate. But if you get a good answer, you should really sit down with somebody who's experienced and does this a lot, just so you feel comfortable moving forward.
Right. And if you need somebody, feel free to, if you don't have an advisor or you're not sure your advisor is experienced in insurance. I started doing this in 1994 with one of the large mutual insurance companies, and basically spent the first 5 years of my career doing nothing but life insurance. So I learned a lot about it and still incorporated it into our practice, and have tried to pass most of that knowledge on to Ryan, and he probably knows more about it than I do at this point. So we've got two good resources right here. Finish this up, Ryan? I think we're good?
I think we're good, yeah. Yep.
Okay, so grab that resource on the website, the Insurance Shoppers Checklist, and thanks for joining us on the Financial Advocate, and we'll talk to you next time.
Thanks.